Hey, I'm back. It's your girl, Shirley Nichols, here with Mortgage Money with Shirley. It is Friday, y'all, and we are here. Yes, as I told you, I am Shirley Nichols on Facebook and on my YouTube channel, Shirley Nichols, and we are doing our Mortgage Money with Shirley. Yes, and like I said before on previous podcasts, I am on twice a month. The first and third Fridays of each month. This month, I didn't quite get to the first Friday because I was a little late in my March podcast where I had to do the last Friday in my March podcast. But nonetheless, again, if it's not the first and third Fridays, it will be twice a month every month, okay? Twice a month on a Friday, typically the first and third Friday of each month, okay? The first and third Friday of each month, 9:30 Pacific Coast time, and we're right here live. So you can call in if you have any questions, comments, or concerns, or you can leave your questions, comments, or concerns right there in the Facebook comment section, or you can DM me, private message me, but subscribe to my YouTube channel. If you haven't subscribed to my YouTube channel, please take a look at that. I'm also on Instagram under Mortgage Money with Shirley, so you'll find me, okay? Instagram, Mortgage Money with Shirley, my Facebook business page, Mortgage Money with Shirley, my YouTube channel, Shirley Nichols. Subscribe and tell all your friends and family because I promise what I have to share, you're going to want to hear it. Okay? So happy April and Easter to everyone. You all, thank you so much. I appreciate you. Again, I'm Shirley Nichols. I'm a mortgage broker. I've been in this business for over 28 years, and I'm here to bring you some business, bring you some information that I know you can use, okay? My NMLS number, I keep forgetting to say this every podcast, but my NMLS number, 105989. 105989 is my NMLS number. And like I said, any questions, comments, or concerns, just let me know in the comment section, or you can call in live in the studio if you want, okay? We're on for about 30 minutes, and today is episode 21. And again, the call-in number here at the station is area code 323-815-4204, 323-815-4204. So if you have questions or comments and you want to call in, please do. And at the end of the podcast, I will definitely get to your questions, okay? No problem. But today's episode, y'all, we are on episode 21. And episode 21, we're going to talk about forbearance or deferment. Okay, I see a lot of the forbearances and deferments coming up now, now that the whole pandemic is kind of closing out, kind of going down a little bit. The numbers are decreasing and whatnot. I see a lot of clients who are at the end of their forbearances or their deferment. So let's talk about it, right? Let's talk about it. What is it? What do we do? How do we do? How do we keep trying to buy a new property or refinance another property? Well, let's talk about this. So there's two programs or two options that were allowed or allotted to a lot of homeowners during the pandemic. Outside of you had your renters who were doing the whole moratorium with their landlords where they put a freeze on having to pay the rents. That whole moratorium was for the renters, but the homeowners also had something kind of similar to what they called a moratorium, but it was more of a forbearance or deferment. So what is it, Shirley? What is a forbearance or deferment? Because they are two separate things, okay? They really are. And I hate to say when one is better than the other, but let me explain. So if you are in a forbearance, that basically means that you decided that whatever difficulty you may be having, or if you decided to opt out of making a mortgage payment, you called your mortgage company and said, hey, we're going through this whole pandemic thing and I'm running upon hard times. Now, let me also alert you all. Forbearance is nothing new. Okay, that's nothing new just because of the pandemic or COVID, but you heard about it more so whenever there's a nationwide crisis, a world crisis, i.e. the pandemic, the COVID 2021, right? So it was more prevalent and you heard about it then more so than ever. And you also heard about it during the crash of the market in 2008. Right? So it's just coming back around now here in 2020, 2019, Did I say COVID 2021? Anywho, I just thought about something. But forbearance is nothing new. Okay. And that's just what I want to make sure you all understand. It's not something new that just was brought up because of COVID. No, it's been around for years and years and years. But what a forbearance does for homeowners is it allows you to, and not just for homeowners, right? Because you also have people who have student loans who get forbearances on their student loans and all other kinds of installment plans. There are forbearances. Okay. And it basically means that you have been allotted time to, reconstruct maybe or redo your financial outlook, right? And you've given yourself enough time, or the company, whether it's Sallie Mae's student loan, the United States Department of Education, they may have given you a forbearance, or they've given you an allotted amount of time to get yourself together financially, right? They've given you a break, so to speak, right? They've given you a break from having to make your mortgage payment, or like I said, whatever installment plan that you are under this forbearance with. It's just giving you a break for a certain amount of time to get yourself together. Now, what I noticed with COVID and the pandemic in this junction, when you are doing a forbearance and you've given yourself a time frame to not have to make a payment. In this era, they also said, we'll go one better. We won't have a negative impact to your credit. Aha. Yes. So that was one thing that I saw that was advantageous to homeowners, because like I said, back, years prior, before COVID and the pandemic, they did forbearances, but it often dinged your credit, right? Same thing with student loans. It would have a negative impact to the credit report. But this time around, in this era, when we saw the forbearances coming through, they also said, hey, we're not going to negatively impact your credit. So this was a great thing, right? And I'll talk a little bit more about was it really great or what it was, okay? So that's the forbearance, right? Where you did not have to make a payment for a certain amount of time, and it did not negatively impact your credit. Great, right? Now, a deferment. A deferment is a little different, right? And a little different in the aspect of it's just deferred payments, right? Deferred payments, meaning that deferment would, if you didn't make your mortgage payment, and let's just say your mortgage payment was $1,000 a month, right? And during this deferment, again, a certain amount of time is allotted to the homeowner, or it could be a student loan or whatever have you. Whatever installment that you owed money to, and you got this deferment, that deferment and the allotted amount of time. And again, like I said, I'll use the example of your mortgage payment being $1,000 a month. So with the deferment, that $1,000 per month is just deferred to a later period, deferred typically to the end of the loan term, right? So let's just say you did a 12-month deferment, right? And your mortgage payment's $1,000. So that $12,000 actually is deferred to the end of your mortgage balance when it is due, right? So if you have a 30-year term, that deferment of that $12,000 is typically due at the end of that 30-year term, okay? So if your mortgage payment, you got a mortgage in the year 2000 and it's not set to mature to the year 2030, that's when you'd owe that $12,000 on top of whatever the remaining balance is in the year 2030, okay? That's what the deferment does, right? Forbearance, on the other hand, it doesn't defer, but what happens is if you owed $1,000 a month, at the end of your forbearance, typically, they want that monies, right? So if your forbearance is 12 months long and you owe $12,000, typically that mortgage company or whomever you have, that mortgage company, I'm going to speak specifically about mortgages because it's mortgage money with Shirley, but that forbearance amount, that $12,000, when that forbearance period is over, they typically want their $12,000. Okay. They want it after that forbearance period is over. Now, what we have seen in the mortgage business is some or most clients, because they may or may not want to pay, or they may or may not have the $12,000 lump sum at the end of that forbearance, what they then do is take this forbearance monies and they move it over to what is basically known now as a modification plan or a deferment plan. Okay. And that modification or deferment plan basically says, okay, we're going to take this $12,000 and now we're going to chop it up into XYZ payments until that's paid off. Or they will again defer it over to the end of the year. Okay. So again, two separate things, forbearance and deferment. Typically people start with the forbearance and then they roll it over to a deferment. Or it could be just a deferment to begin with, a deferment or a modification. Those two words we kind of use interchangeably, deferment and modification. Those are the two words that we use kind of interchangeably, okay? But a forbearance is something separate from a deferment or modification. And like I said, what I've been seeing, what's been coming across my desk are a bunch of forbearances that want to refinance and or they have rolled it into a modification or deferment. So let's talk about that and the refinancing aspect of it all. So you call me, hey, Shirley, I want to do a refinance. This pandemic is over. I'm back to work. I can start making my payments and I need to do a refinance to get myself caught up on some other bills. You know, maybe I need to do a cash out transaction or maybe I want to do a home improvement loan. So can I refinance and pull some of this cash out? Because lo and behold, this is Los Angeles County and the values are going up, and they are super high now. And, you know, my clients just go on and on and on. But the thing I want to point out is, how does forbearance and deferment relate to getting a refinance or buying a new property? So let's talk about it, all right? So again, remember, forbearance is one separate item and deferment is another separate item, okay? So you call me and say, hey, Shirley, I want to refinance. And I'll say, great. So let's talk about that forbearance that you had, right, last year. So tell me what's going on with your forbearance. Now, here's the key. With the forbearance, if you can recall, I said, if you owe $12,000, this is just the example. If you owe $12,000, that's what's expected to be paid right now before the refinance is over. Okay, before the refinance closes, before you go to escrow and you sign all your loan papers, that money's, that $12,000 for this example, that $12,000 has to be paid off. Well, Shirley, that's why I'm refinancing, to get the money to pay it off. Unfortunately, that's not how it works in the lending world. Okay, so that is why I said some people look at forbearance as a better way of handling your financials, and then some people look at it as the worst way between the two, forbearance or deferment. But let's talk about it a little bit further. Forbearance, again, if you call me and want to refinance or you want to buy a new property, that forbearance monies has to be paid right now before we close this transaction. Even though you're doing a cash out refinance. And again, in some of my other previous podcasts, we talked about what is a refinance, a cash out refinance. You're going to pull money, the equity from your home, and we're going to, the lender is going to extend that to you. That's a cash out. And you're probably thinking, if I do a cash out refinance and let's say I get $100,000 out of my property, why do I need to give this lender $12,000 before I can get the $100,000? That's just the Fannie Mae and Freddie Mac guidelines, okay? So if you call me and you want to do this cash out refinance, or if you want to do a refinance period, rate and term, call it that, whatever refinance you may want to do on this subject property that had the forbearance, I'm going to say you got to pay that off before we close. Okay. Now, some other clients have said, but Shirley, I don't have the $12,000 to pay off that forbearance and I need to refinance. I need to refinance now. And I'm going to say, I understand, but you'll have to wait 90 days. Ha ha. So let's talk about that. So you had this forbearance, right? And it's over. It was over April 1. And now you want to refinance. And I'm going to say on April 8th, you got to pay that off. You call me up. Hi, I want to refinance, Shirley. Okay, did you pay off that forbearance, that $12,000 on April 1? Did you pay that off yet? Nope. Pay it off today and we can continue. I can't pay it off. If you cannot pay it off, then I'm going to advise you'll need to call that lender, right? Let's just say you're with Bank of America, right? And Bank of America said, oh yeah, your forbearance amount that's owed is $12,000. You're going to call Bank of America and you're going to say, geez, you know what? Can't pay that. Can I get a deferment plan or a modification plan? Okay? A deferment plan or a modification plan to pay in installments this 12 grand along with your entire mortgage, okay? They're going to set you up on a whole new mortgage plan, right? So your mortgage plan, it may have been $1,000, and then you're going to call them, whomever your existing mortgage company is, you're going to call them and say, hey, I need to move into a modification or deferment. They're going to say probably yes. And that $1,000, they'll reconfigure and give you a whole new plan. And that $1,000 will probably go down to about $700. But guess what? Make sure you read the fine print, because I'm not saying Bank of America, but I am saying there are a lot of banks out there, a lot of mortgage companies, a lot of private mortgage companies that will reconstruct and put you on a deferment or a modification program. They will do this for you. And all of a sudden, like I said, that $1,000 payment becomes $700 over the course of 40 years. Understand what I'm saying? Over the course of 40 years. But I had a 30-year term and all I wanted to do was just do this modification program. I understand. But whatever your existing mortgage company allows, it's what it is, right? If you want to refinance and you owe this forbearance amount, or if you've had a deferment or a modification during the pandemic, if you do have that, then you must wait 90 days before we can refinance. Because during this 90-day period, you're going to have to show you've been making those monthly payments. It'll take 3 monthly payments, 3 on-time monthly payments. And that is why I said, if you want to refinance with the forbearance or deferment, the lenders are allowing that. Yes, they are. However, the forbearance monies, all of it that was forbearance, forbeared, will have to be paid off. The deferment or the modification, you can refinance after you've made 1, 2, 3 consistent mortgage payments on time. So again, if you called up that existing mortgage company that you have and said, hey, I need to get into a deferment or a modification plan, no problem, no worries, right? But you have to make whatever payment you agree to with them. You have to make 3 of those monthly payments before we can refinance. And then after those 3 monthly payments are made, as long as your credit score is a 620, which it should be, because remember, they weren't negatively impacting your credit during the COVID, right? If you had a deferment or a forbearance, they weren't negatively impacting your credit report. The only thing they were doing was they just simply wrote on your credit report, this loan is in forbearance or this loan has been deferred. Whatever the terminology that went along with your existing mortgage, that's what they put on the credit report, okay? It wasn't any, you got a 1 times 30 or a 2 times 30 or 1 times 60 because you didn't make your payment in 2 months or in 30 days, whatever that case may be. None of that is on your credit report. So that's why I said your credit score really should still be at least a 620 unless you had some problems with your credit cards or something, you know? So again, I want to make sure we're real clear. Forbearance is one thing, deferment modification is another. And it doesn't matter. Neither of them are better than the other, in my opinion. It's just, what do you want to do? What can you handle, right? Because again, if you are a homeowner that said, oh, I don't want the forbearance thing, I just want to have a deferment, I want to have all these payments that I don't make deferred until the end of the term, that's no problem. But when you call me to do a refinance, I'm going to say, well, Freddie Mac and Fannie Mae said you have to wait. If you're in a deferment, you have to make 3 on-time payments. Because remember, just like the forbearance, during your deferment, you're not having or you're not required to make any monthly payments, okay? In the deferment period, whatever time they allotted you for, you are not required to make a monthly payment. But if you decide that you want to refinance, right, and maybe the deferment plan is not over until, the end of the year, but again, because it's not negatively impacting your credit, you can call me before the deferment plan is over. You can, but what you need to make sure of is when you do get ready to refinance, those 3 consistent payments have been made and that you understand we're going to ask you to end that deferment. Okay? So, and it will be ended anyways because we're going to pay off that existing mortgage that's in deferment, right? And we are going to pay that amount that's deferred. Now, that's another thing. A lot of clients, I don't know, they perhaps they just are unknowing, but that is why I said, if you don't know what you're signing, call your mortgage professional, call your mortgage broker, give me a call, right? Call me. If you don't understand what it is that you're signing, give me a call before you sign it. Because again, that deferment is very specific. And like I said, a lot of private lenders, mortgage bankers, a lot of them are offering these deferments and modifications, and they're like 40-year terms. And if you sign that, not that you have to stay in it for 40 years, but here's the thing, here's the concept. All the payments that you skipped or missed are deferred to the end of that 40-year term, okay? And by golly, the payments are so low, all the payments really cover is the interest. So that is why it's going to take you like 40 years to pay it off, right? But what I'm trying to say is if you refinance after you've made those 3 consistent monthly payments because you're in a deferment and now you're going to start making payments. Remember, 3 consistent monthly payments, right? You're going to start making those 3 payments. And after the 3rd payment is made, then you're going to call Shirley. Hello, I want to refinance. I'm going to say, okay. And we're going to pay off whatever that deferment amount is. What are you talking about, Shirley? Well, remember, you went a whole 12 months without making any payments, right? And now at the end of these 12 months, you started making payments. But these other 12 payments, that $12,000, yeah, we're going to pay that off in your refinance, right? And that's what some clients, I think, kind of, they miss that part, right? You want to refinance. So we're going to pay off what you owe. Yes. And because the thing about this $12,000, right? For some reason, they forgot all about how they skipped those payments. Geez, you went 12 months and didn't make a payment. Kind of forgot about that. But the lender didn't forget, right? They want their money. So you're looking at your monthly billing statement and you're going, I only owe $100,000. So when I refinance and my house is worth $300,000, I can get out $100,000 because I only owe $100,000. And then when I call you and say, you're not really going to get, $100,000. You'll probably get $88,000. Well, why am I only going to get 88 instead of 100, Shirley? Well, remember that $12,000 deferment that you have, we are going to pay it through the refinance. Unlike a forbearance. The forbearance, you'd have to pay that $12,000, right? And then you'd get the entire $100,000 for your refinance. But in a deferment, you're not going to pay off that $12,000 immediately before we close your loan. You're going to pay it through the refinance. And so instead of you thinking you're going to get this full $100,000, no, you're going to get $88,000 because we're going to pay the deferment. Now, I know I've spent quite a bit of time about these deferments and these forbearances, but because now more than ever, we're seeing an influx. I mean, the phones are ringing because there's a lot of people that now want to refinance, and there's like once before, I am pro refinancing. I am an advocate for the refinancing. That's why there is a program called refinancing. Use it to your advantage. Don't feel bad. Don't feel slighted. Don't feel jaded. Just whatever your financial concern is, use it, like they say, before you lose it, right? Newsflash and alert. You heard me mention something about, hey, you only needed a 620 FICO score. Yes, this last week, rates gone up, but FICO scores, the required minimum score has dropped. During this whole COVID season, pandemic season, we saw lenders actually increase their FICO score requirements. And some of them went up to like a 640 to do this or that kind of program. Well, within the last week, great news. Your minimum required FICO score on most programs can be as low as a 620. Mm-hmm. And if you listen to other previous episodes of my podcast, you'll hear me talk about the credit scores, ins and outs of FICO scores, and how to strategize to perhaps get your credit score up. I touch on that a little bit because by no stretch of the means am I a credit fixer-upper or a credit guru. I am none of that. But I've been in this business for over 28 years, and I kind of know a little something about your credit score. So if you listen to previous podcasts, you'll hear me talk a little bit about how to maneuver and strategize to get your credit scores up. But the great news of today is those minimum FICO scores have reduced from the 640 that a lot of lenders were requiring. That has been reduced from a 640 down to a 620. So let's get the phones ringing some more. And it's okay. Again, I stress to you, it is okay. If you had a forbearance or a deferment during the COVID season, it's totally okay. Let's just, discuss what your best option is, what your next steps are if you'd like to refinance, okay? And we're talking about the subject property. Now, I want to, we always run out of time, and I had some more stuff to talk to you guys about, but I'll save this reverse mortgage business for another podcast. But just know, FYI, alert, 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 the lowered FICO score I just mentioned from a 640 down to a 620, they've also lowered the age minimum requirement for reverse mortgage. Wow! So now you can be 55 years of age and do a reverse mortgage. Okay, you guys might think I'm a little animated and excited about that, but that is great news because you won't understand how many clients I've gotten phone calls from in the past about, but I'm only 57 and I want to do a reverse mortgage and I can't because I'm not 62. You can be 55. Okay, just thought I'd mention that. But again, like I said, I wanted to talk about that, but I'm running out of time. And I just want to make sure I drive home this forbearance and this deferment business because I have an example I want to talk about real quickly with you guys. Now, you heard me say forbearance is one thing, deferment is another. Forbearance, you got to pay the whole outstanding forbearance amount off if you want to refinance immediately. Deferment, you got 3 months to pay 3 monthly payments. One payment for this month, one payment for that month, one payment for the third month. 3 monthly payments must be made on time and consistent for 3 months, right? That's the deferment if you want to refinance. Forbearance, pay the whole thing off and you can refinance now. You don't have to wait the 3 months. Now, that's for the subject property. Okay. Now I want to talk about this one particular example because this is something very recent that just really happened to one of my clients. And unfortunately, it just didn't go the way we anticipated. Right. So she wanted to refinance, right? One of the properties, the subject property on a forbearance. Okay. The dollar amount was owed, let's call it 30 grand. Okay. So she was going to pay this 30 grand for the subject property to get this refinance going, right? So that was one thing. However, okay, and this is very important. Listen very closely and carefully because, again, Fannie Mae and Freddie Mac, they're not playing about these forbearances and these deferments if you want to refinance. They're not playing. They're serious about this. Because one, the credit score hasn't been impacted. Neither has your credit. So that's a great thing. But Fannie Mae and Freddie Mac still have to make sure you can afford your mortgage payment. And if they refinance you and that mortgage payment goes up higher than what your existing payment is, Fannie Mae and Freddie Mac have got to make sure that you can afford it. Okay? Nobody wants to hear that awful F word, foreclosure. Nobody wants to hear that word. Nobody wants to do that. So in order to make sure that you can afford this new payment on a refinance, that forbearance is very serious. You got to pay the whole thing off, or that deferment is very serious. You have to wait until you have 3 on-time monthly payments, right? My client, Subject property was in a forbearance, she's going to pay the 30 grand off. However, there is another property, and it is a rental property. It's her investment property. And that too was on not a forbearance, but it was on a modification / deferment, right? Remember, I said modification and deferment is the two words we kind of use interchangeably. She was on a modification or deferment plan with the rental property, right? Okay. Now, again, you have to make 3 monthly payments consistently for 3 months. All right. If your mortgage payment is $1,000, then you have to make a $1,000 payment in April, a $1,000 payment in May, and a $1,000 payment in June. You can't do, let's call that, it's $3,000, Shirley. I'm going to pay that $3,000 in April. And then let's get her done. Doesn't work that way. Again, your monthly mortgage payment is required of you every single month. Regardless if you paid $3 grand in April, you just paid $3 grand in April. Maybe that $2,000 that you paid over will go directly towards your principal, okay? But that's all that happens. Those 3 monthly payments, and you call it $3,000 that you paid in 1 month and you paid it in April, it does not mean they're going to, the lender, they're going to spread out $1,000 to the May payment, $1,000 to the June payment. They're not going to do it. No. Instead, they're going to say, oh, thank you, Mrs. or Mr. Client, for your $3,000 contribution to your mortgage balance. Now, where's the May payment, right? So essentially, that's what happened to my client, right? She made a lump sum payment in December of 2021, right? But now we're in the year 2022. And this lump sum payment that she made in December of 21, that lump sum payment does not go towards your January, February, March, and now we're in the month of April. It doesn't go to those monthly payments. No, it doesn't. Okay? So be mindful of that, because that is exactly why your loan will not proceed. They will not move forward with that refinance if you made a lump sum payment in a previous month, but you did not pay those 3 other monthly payments, okay? And I'll tell you what, another thing, be mindful and careful about these modification and deferment plans, okay? If your modification or deferment plan says, oh, hey, your modification plan, yeah, you caught us in the year 2020, and we're only going to take you through to May 2020, right? So your modification or deferment plan is actually over in May 2020, right? But you, for some reason, didn't read the jargon, and they never even called me, Shirley. They never even bothered to call me when I didn't make the rest of the year 2020 payments. I just took out my paperwork, and yeah, it said it was over in May of 2020, but no one called me. So I didn't make any payments until December of 2020. But guess what? Your deferment was over in May, and you didn't make a payment till December. Those months in between, that's a problem. That's a problem, because you didn't hold up to your end of the agreement. But I didn't know it said May 2020. What am I going to do? You're going to wait now 12 months. And I know that sounds tragic, but that's what the mortgage lending guidelines state. If your modification or your deferment was over in May of 2020, but you didn't make a payment until December 2020, well, now we're going to have to count 12 monthly payments, right? 12 monthly payments from December 2020. So that means from December 2020 through December 2021, there better be payments every single month. December 2020, January 2021, February 2021, March, April, all of those payments for 12 payments must be made. Because your deferment was over in May of 2020 and you didn't decide to start making payments until December 2020, we're going to start from December 2020 for the full 12 payments, not the 3 we just discussed. Because remember, the 3 are only for deferment and modification purposes only. If your deferment and modification plan was over in May of 2020, by golly, that's when you need to start making your payments. Okay? So you should have a payment for June and July and August, and then we could refinance, right? But I say that for the current year. That this example is for 2020, but for the 2022 period, right? For right now, if your deferment, your modification was over January 2022, we had better see there's a payment for February, March, and April, and then we can refinance. Yes, because 3 payments have been made in 1 payment each month for 3 months, right? After that deferment plan was over. Okay? It's so very crucial that you understand this point so that you don't get upset when I, phone you and say, no, we can't proceed, because trust me, the underwriters are going to do their legwork. What you say, Shirley? The underwriters are going to do their research. What you say, Shirley? The underwriter is going to find out whether or not it shows up on your credit report. Because again, remember, I said it doesn't negatively impact your credit report. However, before they fund your loan, before they proceed with any approvals, they're going to say, let me see this deferment plan. And then they're going to say, oh dear, your deferment plan was over January of 2022. Where are your monthly payments at? What monthly payment? The payments that said you need to start making your payment February 1 of 2022. You need to start making the payment now, February 1, 2022. But I didn't see that. Okay, no problem. But it's now April. So because your deferment plan was over in January and you've missed all these months right here in between, now instead of asking you for 3 payments, we're looking for the full 12-month history, okay, after that deferment was over. Yeah, we are. So it basically states that if your deferment was over in January and you have not made a payment and you decide to make your payment in April after it was over in January, we're going to say, okay, April of the following year is when you can refinance. Okay? Because you've missed your window of opportunity for those 3 payments after you've had your deferment ended. After your deferment or modification was terminated, you were to start to make those payments right then and there, then I would have said, great, we only need to wait 3 payments. But if you missed any of those months now, we're going to have to see a 12-month history from the time you make that payment. And I know it's most unfortunate. It really, truly is. But the way the mortgage lending guidelines see it is they gave you a break for however long you took it, whether it was 12 months, whether it's 24 months, whether it was 18 months, however long you took this break for, they gave you a gift, And I know I might be sounding a little biased or harsh because I'm in this business, but that's the real nitty-gritty of it. And that's what I'm here to bring you with Mortgage Money with Shirley on my podcast, okay? Some tips and tidbits, some tools that you can take with you, pack them in your arsenal. But listen, guys, it's very serious, okay, about what we're seeing now that this COVID and this pandemic season is starting to decline. That's what we're starting to see coming across our desk are people who are wanting to refinance. And trust me, we want to help you. As I said on almost all of my podcasts, trust me, the lenders want to help you. They want to extend you this money because that's how they stay in business, extending money. So trust me, they want to give you this refinance loan and I want to give it to you. I want to help give it to you. So trust and believe you me that there are some ways and avenues to maneuver, but you got to start with what's currently being asked, okay? So I hope I've helped and I hope I've given you some tools and tips. Like I said, I'm a little over my time. I'm so sorry, but I just had to drive that point home. And remember,